Wall Street is used to surprises, earnings beats, guidance revisions, unexpected mergers, but it is not used to watching a company outperform on every measurable operational metric and then suddenly see its stock price collapse as if the business were in freefall. That kind of contradiction does not just raise eyebrows. It activates something deeper in investors, a sense that something critical is hiding in plain sight. That is exactly what unfolded around Rocket Lab in late 2025. This is an American aerospace firm based in Long Beach. It had become the second most active orbital launch provider in the United States after SpaceX. It was accelerating across every meaningful dimension. Revenue rising toward roughly $450 million. Gross margins improving into the high 30s. Space systems manufacturing scaling across multiple facilities. National security customers increasing. Launch cadence growing. 2 Electron missions flown within 48 hours. A milestone so rare in aerospace that only the most mature providers ever achieve it. And yet the stock fell from the high 60s into the low 40s. That is not how the market normally behaves. In public equities, when a company executes well, especially in aerospace, where execution is difficult and unpredictable, valuation usually strengthens. Operational success is usually rewarded, not penalized. Rocket Lab broke that pattern. It delivered some of its strongest performance since going public, and the market responded by selling it off. To understand this inversion, we have to return to 2021, when Rocket Lab went public through a SPAC merger with Vector Acquisition. The deal brought in about $800 million. Normally, companies use SPAC capital for expansion. They scale facilities, strengthen supply chains, integrate acquisitions, and fund advanced R&D. Rocket Lab did all of that. It acquired SolAero, PSC, and ASI, building the ability to produce solar arrays, satellite buses, power systems, and flight hardware. It expanded launch infrastructure, and it fueled development of Neutron, a medium-lift, reusable rocket meant to redefine its future. Neutron was not just another product, it was the company's future strategic engine. Electron was performing well, but limited to small payloads. The real economic markets, the mega constellations, the national security missions, the reusable high-mass launches, lived in the medium-lift category dominated by vehicles like Falcon 9. Neutron was supposed to put Rocket Lab in that league. In aerospace, new rockets typically follow a transparent milestone rhythm. Engine tests, first stage integration, fairing qualification, full duration hot fires. Companies share these updates so customers can plan missions and investors can model timelines. Neutron did not follow this rhythm. Through 2022 and 2023, the company shared progress, but in broad brushstrokes. High-level commentary, limited technical specifics, few explicit readiness markers. And while Electron and the Space Systems segment delivered robust clarity, Neutron's program remained blurry. By early 2025, analysts started modeling the gaps. Independent researchers published assessments indicating Neutron's first flight, originally aimed for late 2025, was not feasible. They estimated total development spending climbing toward $400 million, well beyond investor expectations. Cost overruns in aerospace are common, but significant divergence between external modeling and internal messaging is uncommon. It often signals internal program shifts or forecasting inconsistencies. The rupture began in September 2025. Rocket Lab authorized an at-the-market equity program up to roughly $750 million. Normally, companies raise capital after preparing investors through revised guidance, updated timelines, or expanded CapEx plans. They communicate the need first, then raise. Rocket Lab reversed that sequence. The ATM authorization arrived suddenly and collided directly with growing speculation about Neutron. Investors began asking whether Neutron was consuming far more capital than expected, whether internal delays were known earlier, whether the company aimed to raise funds before acknowledging a slip. None of those questions had clear answers, and the absence of clarity fed the mystery. Then came November 10th, 2025. Rocket Lab reported exceptional quarterly results. Revenue near $155 million, around 50% year-over-year growth, gross margins approaching the high 30s, an EPS beat, backlog stabilizing around the $1 billion mark. And then came the confirmation investors had braced for. Neutron's first launch would move into 2026. Development costs had surpassed earlier expectations. In aerospace, delays happen often. They are usually communicated gradually so that partners can adjust. Rocket Lab's delay confirmation arrived only after the company implemented one of the largest funding authorizations in its history. This inversion was not only unusual, but strategically significant. It introduced questions about disclosure pacing and program transparency. Yet the paradox deepened. Within days of confirming the slip, Rocket Lab executed 2 Electron missions within 48 hours from different hemispheres, a remarkable operational milestone. Under normal market logic, investors would interpret this as a sign of organizational maturity and engineering excellence. Instead, the stock did not respond. The market no longer cared about Electron. It cared only about Neutron. By December 1st, the stock hovered around $40, sitting near its 200-day moving average, a classic long-term support indicator, but staying below its 50-day moving average, showing weakened momentum. RSI drifted near mildly oversold territory. Short-term traders anticipated rebounds toward the mid-40s. Medium-term traders waited for a break above $50. Long-term investors saw potential entry points in the mid-30s, betting that a successful Neutron flight in 2026 and early commercial service in 2027 could push valuation back into the $60 to $70 range. Investors understood the emotional tension. Rocket Lab's present was strong, its fundamentals solid, its operations expanding, but the stock was no longer trading on the present. It was trading on the uncertain future of a rocket that had not yet flown. A rocket whose cost curve was evolving. A rocket whose timeline structured the entire valuation framework. This is the core of the mystery. Rocket Lab's present performance is real. Its future risk is also real. The market has chosen to price only the latter. Before we close, we want to say something directly to our listeners. ValueStir is always watching for both public and private equity stories, and we want your help. If there is a stock or crypto asset you want us to investigate, whether it is already trading or preparing to enter the market, tell us in the comments. We mean it. Your submissions shape what we cover next, so drop your ideas below and guide this channel's next deep dive. And to everyone who watches, subscribes, comments, or shares these episodes with friends, thank you. Your support is the reason we can keep building stronger and sharper content. Until Neutron flies, Rocket Lab will remain suspended between present strength and future uncertainty, valued not for what it has achieved, but for what it still must prove. This was ValueStir.